Here's why the market crashed this week and market update for the next week. Hi folks, I got a good one for you this week. Welcome to Take It Easy Trading, your channel to get some stock market updates, macroeconomic review, stock and index chart analysis, and weekly earnings review. In the future, I'll be sharing about my Take It Easy trading system as well. Please subscribe, like, and click the bell icon to get notified of new videos. Thank you for your support. Let's begin. Topics for this week: weekly market performance, market breadth, macro view of CPI and FOMC this week. We'll review the Fed's actions and the market's disconnect from the reality. Then we look at next week's calendar. Let's look at the weekly market performance. Dow Jones was down 1.7% for the week and 9.4% for the year. S&P 500 is down 2.1% for the week and 19.2% for the year. Nasdaq is down 2.7% and 31.6% for the year. The EFI index is down 0.9% for the week and 16% for the year. 10-year Treasury is at 3.49% and minus 0.1% for the week and 1.9% year to date. And the bonds, which is the ETF AGG, is closed at 99.38. For the week, is up 0.6%, and for the year is down 10.7%. Next up is the economic activity from this week. We had good news on inflation that came on Tuesday as the Consumer Price Index report for November showed the smallest monthly advance in over a year. The overall CPI increased to 0.1% from the prior month and was up 7.1% from a year earlier. Excluding volatile food and energy components, the core CPI, which is Fed's favorite, rose 0.2% in November and was up 6% from a year earlier. Previously, it was 6.3%. So this shows that the Fed's actions are actually working in reducing the core inflation. This actually kicked off a huge rally on Tuesday, and then you saw it a gap and crap as the market got way ahead of itself just before the FOMC decision the next day on Wednesday. On Wednesday, the Fed delivered a much anticipated 50 basis point interest rate hike. They now see a slower economic growth of 0.5% for 2023. That's the most you get from Fed, that we are expecting a negative growth next year, aka recession coming up. What got the markets was a higher revision of the terminal rate of 5.1%, and the market was expecting roughly around 4.7 to 5%. Stocks turned lower after Fed Chair Jerome Powell said the central bank needed to see more evidence to be more confident that the inflation will sustain its downward path. Perhaps what was less expected by markets was that the Fed's dot plot, or the estimates of where the interest rates are headed, indicated a peak Fed funds rate of 5.1% in 2023, and then it dropped to 4.1% in 2024. A rate cut of 1% in 2024 is expected, and another rate cut of 1% is expected in 2025, and the long term is not changed. It's still at 2.5%. Market expectations. The Fed indicated no rate cuts in 2023 and about 100 basis points of rate cuts in 2024. I believe that the Fed can start to signal rate cuts by year-end 2023, but not before, as the market is still expecting them to cut the rate in end of 2023. What if the core CPI comes in hotter again? Fed cannot signal until they see the trend continues and the core CPI comes in at least less than 5% next year, while the peak rate is still at 5%. In February, the market is expecting a 0.25% rate hike, followed by 0.25 in March. They are still expecting a 0.25% rate cut by end of 2023 in November and then in December. That is the disconnect that the market had from the Fed's expectations this week. And we saw the bloodbath that followed. Manufacturing PMI fell to 46.2% in December of 2022 from 47.7% in November, well below the forecast of 47.7. The recession is here. The reading pointed the biggest contraction since May 2020 as we had less demand and a faster fall in the output. New orders also declined at one of the sharpest paces since the 2008 financial crisis. For the next week, relatively quiet Monday and Tuesday. Wednesday, we should see consumer confidence, which is expected at 101. On Thursday, we'll get the GDP for Q3 expected to grow at 2.9%. On Friday, November Personal Consumption Expenditures (PCE) price index, the core month-over-month is expected to grow at 0.2%. Core year-over-year is expected to come in at 4.6%. The core PCE is the Fed's favorite inflation gauge. It excludes food and energy. If the PCI data suggests that the inflation is still burning hot, then the Fed may have to keep its foot on the gas. Let's look at the market breadth from this week. NYSE, we had 13 new 52-week lows and 126 new 52-week highs. On NYSE on Friday, we had more declining volume than the advancing volume. Same on the Nasdaq as well. We had 510 advancing issues over 1421 declining issues, and in Nasdaq, 37% were advancing and 60% went down. Let's look at the summary of stocks with new highs and lows. We have 63% or 3330 of the stocks hit new 5-day low, and 39% or 2047 issues hit new monthly lows. 10% or 506 new 52-week lows this week. This shows that the internals are very weak for any rally to sustain. Let's look at the 5-day average. There are 19.63% of the stocks are above 5-day moving average compared to 31% last month. And for 50-day moving average, we have 45% of the stocks above 50-day moving average, and 65% was the number last month. So it's clearly declining. And looking at 200-day moving average, we have 37.75% as of today above the 200-day moving average and 41% as of last month. The internals continue to show there are problems if at all there are any rallies coming. The breadth is not supporting the rallies. Earnings look this week. This week we had Oracle, Lennar, and Adobe. We saw a slight pop in Adobe after hours on Thursday, and even today on Friday it was up roughly 7 or 8 points. We'll look at some charts for Oracle and Adobe. This is a long-term chart of Adobe. It's a weekly chart. The slide has stopped at exactly 61.8%. It's a retracement from the 2008 lows to 2021 highs. It tried to pop over 350 today, which is 50% retracement. If it can clear 350, it has a potential to reach and test 38.2 retracement at 430-ish. The stochastics show a positive momentum, which should help find some support if at all any weakness comes in the next few weeks. Now let's look at Oracle chart. Same here, the slide has stopped at short of 50% retracement from the dot-com bust lows in 2003. The stochastics show a positive momentum which is peaking, which should put some downward pressure if at all any selling comes in. Next week earnings. Investors will pay close attention to Nike's results after the bell on Tuesday. Nike should provide insight into how strong the Chinese consumer is and provide one of the latest updates for holiday spending. Other key earnings include General Mills, CarMax, Micron, and FedEx. And we should look at Micron to see if there are any shortages in the inventory levels, should put some pressure on the chip stocks, and also look at FedEx for economic activities. Let's look at the chart for Nike. This is a weekly chart. The downward slide has stopped at well below 50% retracement from the all-time lows. The stochastics show a positive momentum which is gathering should find buyers on any selling pressure. So I would see probably a retest of 89 and then head towards 110 plus for 38.2 retracement. Now let's look at the FedEx chart. This is the same weekly chart for FedEx. The downward slide also stopped at well below 50% retracement from the all-time lows. The stochastics are a little positive, showing some momentum is gathering, and there should be buyers if at all any positive news comes out of the FedEx. And finally, we have Carnival weekly chart. Oh boy, it has been down roughly about 95%. The weekly stochastic still in the downward pressure. I don't see the uptake, but it's approaching a climax. If any positive news comes out of CCL, we should find at least a jump towards $17. That's all for this week's update. Please subscribe, like, and comment on anything you like me to add in the next video. And thanks for watching.